Greetings everyone. This is King Solomon, and in today's video session, we'll be looking into the topic POI mitigation. POI mitigation. Sure you all know some of these things already, right? POI means point of interest. And when we talk about point of interest in the market, we're talking about the various zones or levels that we take interest in before placing an order, or the various levels of zones we want to take orders from, right? Be the buy or sell. So this point of interest are actually split into a lot. In ICT concept, they are known as the um they are known as the point of interest levels, right? The hierarchy of the PD arrays, that's the price delivery arrays. But then we'll be looking into demand zone in this video. So demand zone, supply zones are all under other blocks, and these are zones that are characterized by specific details of candlesticks, right? So I'm going to go into that first before going into the structure mapping of POI mitigation, right? Now let's look at something like this. I do see a lot of people mark out respective order blocks, but then I have the way I do mine, and that's the proper concept of order blocks, right? So when you not mark out another block, there are things that you're going to put into consideration before saying, okay, this candlestick is a potential order block, right? The first thing you want to see on a candlestick before calling it another block is an FVG. You want to see an FVG on a candlestick. Now I'm going to use these three candlesticks as an example. So let's say these three candlesticks are actually up candles, that is bullish candles, right? So the green candles. I would have done this together, make it faster. Right, this and okay. So let's say we have these three candles, and you're asked to spot out a valid order block, a valid point of interest when it comes to order block. So you know, make sure that the order block you're marking has a fair value gap. And how do you identify a fair value gap? It's always the space between the high of the first candle and the low of the third candle when it comes to the buy. The high of the first candle and the low of the third candle. So how am I going to mark this out? I want to mark out this high. I want to mark out a horizontal line, right? And then I want to mark out a horizontal line at the bottom of the third candlestick as well, like this, right? The high of this first candlestick and the low of this third candlestick. If there is a gap there, that's the fair value gap. That's the fair value gap. Now, if a candlestick comes to wick into this space, I'm going to put this as a yellow space so you'll be able to understand. Let's say this is the FVG, right? Let's say this is the FVG. FVG, middle, center order. So let's say a candlestick, right? The candlestick comes to tap into this FVG. Let's say we have another candlestick here. Okay, in this case, let's say it's a bearish candlestick, right? Bearish candlestick in this case. And then either the body or the wick of the candlestick comes to tap into the FVG. You can see the space has been closed, right? That means the FVG has been closed. But before this thing takes place, you want to make sure that the other block you're marking, that's the candlestick you're marking as the other block, has this FVG in place, right? That's the first criteria of selecting your other blocks when it comes to your point of interest. Now, the second one is that you want to make sure that that candlestick you're picking as your other block took out liquidity from the former candlestick. Now, let's say we have a former candlestick here, right? Let's say this was a down candle, that's bearish candle. and it's like this. Now you want to make sure that the low of the candlestick you are using went below the low of the former candlestick. Now, what do I mean? You can see that this low went below this low. If you want to mark it out from here, you can see that this low took out the liquidity, right? This low took out the liquidity. This should be a red candle. This should be a red candle. So this low took out the liquidity, isn't it? Now, when you can see this, once you see these two confluences on this, on your candlestick, now this candlestick is now worthy of being called an order block. It's now been worthy of being called an order block. I'm gonna make this a bit thicker, in the red, right? So the first one is the FVG presence, and the second one is the liquidity grab of its former candlestick. Now, this candlestick itself would now be regarded as an order block. Most of the time, how I do mine is actually picking from the body of the candlestick to the low, right? From the body of the candlestick to the low. I'm gonna do something like this. Something like this. Right? Now, I'm going to mark this as my order block. That's the OB. Now, this that I used is for the demand zone, right? You know, the order block is split into the demand and supply zone. This is for the demand zone. But then when it comes to the supply zone, you're also using the same criteria to mark out your order block. But everything is going to be inverse. It's going to be upside down rather. So I'm going to use my chart inverse for you to see this. All right. Now just see this, my red candle as the green candle, and this green candle as the red candle. All right. So now it's still the same case. In this scenario, your order block should be, or should have, a space between its low and the high of the third candle. That's our FVG, and then to take out liquidity from the former candlestick. So it's actually following the same criteria, but then it's just upside down when it comes to either the demand and supply zone. Now let's move into the chart structure itself. Now there's always a question traders have, or the newbies, right? And it's always, when it comes to POI mitigation, which order block am I to use? I don't know the correct POI to choose to trade from, this and this and that. Now I want you all to know that choosing your favorite and valued order blocks or zones in the market is always in respect to liquidity, right? It's always in respect to liquidity. Take a look at this chart, or this part example I drew here. We had a break of structure here. We had a break of structure again here, right? Now at this extreme, we had an unmitigated demand zone. At this point also, we have an unmitigated demand zone, right? What do I mean when I say a POI is unmitigated? It means price has not tapped into it yet. If this low actually came like this to tap into this zone, it would have been called, what? A mitigated zone. But then since it has not happened, this is what? An unmitigated zone, right? An unmitigated zone. Now, the question is always, so am I to use this one or to use this one? Now, something you should know is, while marking out your various points of interest in the market, you want to make sure that you're trading in respect to liquidity, right? Now, in this case, most of you all, of course, you're going to call this low as an inducement, right? You're going to call this an induced low. I'm going to identify that as the IDM, right? So the question is, okay, should I trade from here? Should I trade from here? This and this. Now, in the former video I made on market fractality, I was able to show you all how you can, from the different time frames, mark out your various structures, right? Mark out your various structures. When it comes to this case of this structure, what you can actually see here is just a one-way structure, right? Let's just say we're using the 1 hour time frame, for example. This is a one-way structure we're having here. Now you want to make sure that the other blocks you're marking as valid has not been mitigated. Now this has not been mitigated. This as well has not been mitigated, right? Now this can be a valid order block. This as well can be a valid order block since they've not been mitigated. But now there's something that you should watch out for, but there's something that actually happens. Imagine price coming into this unmitigated zone, mitigating this zone, right? I'm going to use a path for this. I'm going to use a path, right? You see price coming into this zone, mitigating this first zone, and then doing what? Going back up. So now you can see after the RT, which is the return to order block, this first demand zone has been mitigated. Now we still have an extreme unmitigated demand zone. If thereafter we have a break of structure, this, right? If thereafter we have a break of structure, you are sure, of course, you're going to have a new demand zone around this level. You're going to have a new demand zone around this level, right? Now, this unmitigated zone will now be what now? It will now be a mitigated zone. A mitigated zone. Now, when it comes to POI mitigation, there's something that I teach on this, and that is selecting your power levels, understanding power levels. Now, power levels has to do with differentiating the zones in the market, which has the power to make potential and significant price movements, right? That are capable of initiating or causing real price action, right? So in this case, this mitigated zone has caused a real price action for it to break structure to the upside, for it to take out this former side liquidity, this former buy side liquidity, right? Now it means it has done its job by taking out this BSL, by making it a break of structure, right? Now this mitigated zone has used its power. This formerly known as unmitigated zone has used its power. That's why it's now called a mitigated zone, right? Since it has broken structure to the upside, this low is now a strong low. Now, power has been what? Power has been shifted from this low to this low. For this low here to cause for this low's OB to cause a break of structure to the upside, it means there is power here, right? Now, let's say we add the power here before. Let's say there's a power here. For it to cause a break of structure to the upside, power has been shifted from here to here, right? Now, there's no more power here. That's what you should be conscious of, right? So there's no more power here. The power has now been shifted to this zone. So this is the new what? Unmitigated zone. Now, there's something I really do that helps me while trading, and that's pointing out my various power levels, right? With the knowledge of mitigated and unmitigated zones. Now, let's say you now see something thereafter like this. You see price coming to do this. Now, what comes to your mind first? You're like, this unmitigated zone is supposed to hold since it's a power level, right? It is supposed to what? Hold. But since this zone did not hold, since this unmitigated zone did not hold, and this strong low, this power level, right? This strong low was taken out, right? Now, what does that signify? It now signifies a change of character. It signifies what? A change of character. Now, don't ever say, seems this low is a liquidity and price wants to tap into here. If you're sure that price has actually tapped into the correct order block, once this low gets taken out, you can mark this as a change of character, right? You can mark this as a CH or CH already, because this zone has no power again. What we are focusing on is this are these strong points, and since it has been taken out, you can name it a change of character. What's the change of character? Change of character is the break of strong points. That's simply the meaning of change of character. Why break of structures is the break of what? Weak points, right? So seeing this, something like this, what does that tell you? That now gives you the hand that, okay, price is going to, okay, let me remove this one first. Right? So that's giving the hand that price has changed character. And for a for price to change character, where it was coming from has gained power in a way or another, right? So we can mark this as a strong eye. So what I do sometimes, and this actually occurs mostly during the Asian session, right? That's the midnight session. That's when I mostly see something like this, where I'm going to see price retrace back to potential points, right, before coming for the real zone. Now, you know that price has changed character here. You know that you have an unmitigated zone here. Now, this unmitigated zone is where you want to see price coming to. And anything that would make price not coming to here yet is price preparing itself to come into there. So if you now see price retracing upward like this, right? If you see price retracing upward like this into this zone, you want to watch out for an LTF change of character, and you want to execute a trade into the unmitigated demand zone, which is at the extreme, right? Which is at the extreme. So that means you would have taken a short trade as this. Now, I would have to tell you that this is actually trading against the trend if we are actually bullish, right? If we're actually bullish, this is trading against the trend. That's why you have to be extra careful while doing this. You want to make sure that all these confluences are in place, right? All these confluences are in place. If these confluences are in place, there's really nothing to worry about. But you have to just be conscious of taking partial profits and breaking even if maybe you don't do that on your normal trades, right? You want to make sure that you do it, because it might not be a high probability setup. All right, so that's for that. Then you want to make sure that you see price come into this unmitigated zone. Now, once this unmitigated zone gets mitigated, you are now doing what now? You are expecting a change of character. You want to see price do this. Price come into the zone here, right? Come into here, and then boom, go back up to take out this what? Buy side liquidity, the BSL, right? To take out the BSL. So that's that for that. But then this is a case, right? There's another scenario that can happen that I'm going to show you. And this is the scenario. If price comes to break the former high, in this case, let's say, let's delete this. Okay, let's now see, we now see price coming to do something like this. We see price coming into here, right? Price coming into here. No, we see price from here, go back up to take out this high. Now you now be like, price did not come into this unmitigated zone now. Is it that this was an inducement, this and this? No. Price actually came to create a real inducement. Once price takes out a strong point without tapping into the proper zone that it is supposed to tap into, that point, that new point formed, that new low or high formed, should be regarded as what? As an inducement. So I'll be marking this as an inducement. You know, on the normal case, people might have been like, since this is an inducement here, and this zone might be the real zone and stuff like that. But no, this move is now a potential fake move, right? And you mark this low as an inducement, right? So after this, after you make this buy side liquidity. Mark this as the buy side liquidity, right? And here's an IDM, and here's your unmitigated zone. So this unmitigated zone that you have here is now an extreme zone, isn't it? So thereafter, what you want to see price come back down to clear the inducement formed, tap into the real unmitigated zone now, and go back up to break structure. And there's something that I'll be glad to tell you guys. There's something I used to experience on the chat, right? It's actually kind of very funny, but because I actually know the tactics around it. I've been able to successfully trade it for multiple times, right? And that's price clearing your IDM and resisting to tap into your zone. Price coming down to clear this IDM and resisting something like this. Price coming so close to your zone, taking out the IDM and then going back up to break structure. Some people will be like, is it that this zone is not this thing? Is it that this is not the new strong zone? No, still stand on your point if you've marked your zone as I taught you earlier, using the criteria of the FVG and the liquidity graph from the former candlestick, right? When you have that in place, and also there's something that you should make sure of. You know, make sure that you are you go to, let's say you pick out the other block on the 1 hour time frame, you know, go like to the 45 minutes time frame, 30 minutes time frame to see if there is any refinements that you can do on that time frame. All right. So if from everything, if you're now sure that okay, this is the particular zone, no matter how many IDM gets taken out, you want to still make sure that you're still sticking to your unmitigated POI, right? You're still sticking to your unmitigated POI. In this case, you want to stick to this. This IDM was taken in the first place, then another IDM was created because this zone still remains unmitigated. Except if this I goes to tap into an higher time frame supply zone. That's when it might have the power to take out your unmitigated zone, right? But if it's still valid, right? If it's still in a free space of price action, then you can expect that price will still come down to take out your IDM and tap into your mitigated zone. So apart from liquidity, you want to work with your POI mitigations. You don't work with POI mitigations. You don't only want to work with liquidities alone, right? Trust me, you don't want to work with liquidities alone. You want to work with your POI mitigations as well, right? So you understanding your POI markings, you marking out your POI correctly, then that is going to give you an independent, or is going to give you an upper hand of understanding what the market is doing when it comes to liquidity formation, right? So you know that, okay, this is my zone. Even if price comes so close to you without mitigating it, I'm still going to stand on this same zone, right? But then once price steps into the zone and it gets mitigated, then boom, you are good to go. So that's everything I want to share on POI mitigation. In the next video, I'm going to teach you guys on power levels, right? Power levels is actually kind of related to POI mitigation, but it's more of the chart thing. I'm probably going to use my chart as an example, right? I'm going to use my chart itself as an example for the power levels for you to understand more on POI mitigation, because it's actually under POI mitigation, right? So that will be all on this video. Thank you guys. Watch it all and ask any question you have. See you guys in the next video session.